Want to build real wealth while you're still young? In this video, I'll break down the most common money mistakes people make in their 20s and 30s and how to avoid them. Whether you're trying to save smarter, invest early, or just stop living paycheck to paycheck, this one's for you. Subscribe for weekly tips on money, mindset, and financial freedom. Let's get into it. 10. Ignoring the power of compound interest. One of the biggest financial mistakes young adults make is not appreciating how powerful compound interest can be. Compound interest means you earn interest on your initial investment and also on the interest that accumulates over time. This exponential growth is what can turn small, regular contributions into significant wealth decades down the road. The earlier you start investing, even if it's just $50 a month, the longer your money has to grow and multiply. Even if you don't have a lot of disposable income, taking advantage of employer-sponsored retirement plans like 401(k) or IRAs is crucial. Automatic contributions and reinvesting dividends maximize the benefits of compounding. The key takeaway: start early, be consistent, and let compound interest work for you. 9. Living beyond your means. Lifestyle inflation is a silent killer of financial health. As soon as people start earning more, they often increase their spending on housing, cars, entertainment, and dining out. While it's natural to want to enjoy your hard-earned money, spending more than you earn can quickly lead to debt and stress. Building a lifestyle that matches or stays below your income gives you control over your finances. It frees up money to build an emergency fund, invest, and save for bigger goals like buying a home or starting a business. Tracking your spending monthly and reviewing your budget regularly can keep lifestyle inflation in check and help you build lasting wealth. 8. Neglecting to build an emergency fund. Emergencies don't wait for a convenient time. Unexpected expenses like medical bills, car repairs, or sudden job loss can strike anyone. Without an emergency fund, you may have to rely on high-interest credit cards or loans, putting your financial stability at risk. Many young adults underestimate how important an emergency fund is, often prioritizing other financial goals like investing or paying off debt without first securing a financial cushion. Ideally, an emergency fund should cover 3 to 6 months' worth of essential living expenses and be kept in a liquid, accessible account like a savings or money market account. Having this safety net prevents you from going into debt during tough times and provides peace of mind. Even if you can only save a small amount each month, consistency will build your emergency fund over time. 7. Relying too much on credit cards. Credit cards can be powerful financial tools, but mismanaging them is a common mistake in your 20s and 30s. Many people use credit cards for convenience or rewards, but then carry balances month to month, accumulating high-interest debt that's difficult to pay off. To avoid this, treat credit cards as a tool to build credit and earn rewards, but always pay your balance in full every month. Keep your credit utilization low, ideally under 30%, and monitor your statements for unauthorized charges. Responsible credit card use boosts your credit score, which affects your ability to get loans and favorable interest rates later. 6. Not prioritizing retirement savings. Retirement may seem like a distant concern when you're young, but the earlier you start saving, the easier and more affordable it becomes to reach your goals. Skipping retirement contributions in your 20s or 30s is a costly mistake that limits your financial freedom later in life. Many people neglect to contribute to employer-sponsored plans like 401(k), missing out on free matching contributions from their company, essentially free money. Others delay opening individual retirement accounts like Roth IRAs, which offer tax advantages. Even small monthly contributions add up over time thanks to compound growth. Prioritizing retirement savings means sacrificing some immediate gratification for long-term security. It also reduces the pressure to save huge amounts later in life, when expenses may be higher. 5. Overlooking student loan repayment strategies. Student loans are a heavy financial burden for many young adults. Simply making minimum payments can extend your loan term and cause you to pay much more interest over time. Ignoring or postponing payments can damage your credit and cause stress. It's essential to understand the terms of your loans, interest rates, repayment options, and forgiveness programs. Refinancing or consolidating loans can reduce interest rates or monthly payments, but should be done carefully, weighing the pros and cons. 4. Failing to budget or track spending. Budgeting is the foundation of financial health, yet many people neglect it. Without a clear budget, it's difficult to control spending, save effectively, or reach financial goals. Tracking your income and expenses reveals where your money actually goes. This awareness helps identify unnecessary spending, whether it's subscriptions you don't use, impulse purchases, or dining out too often. A budget is a plan for your money, allocating funds for essentials, savings, debt repayment, and discretionary spending. It helps you prioritize financial goals and stay disciplined. 3. Ignoring insurance needs. Insurance may seem like an unnecessary expense when you're young and healthy, but it protects you from devastating financial losses. Health insurance covers medical costs that could otherwise bankrupt you. Renters or homeowners insurance protect your property and belongings from theft, damage, or disasters. Auto insurance is legally required and shields you from liability and expensive repairs. Life insurance becomes essential if you have dependents relying on your income. Disability insurance safeguards your ability to earn if you become ill or injured. Skipping or skimping on insurance can lead to catastrophic financial consequences. Reviewing your insurance coverage regularly ensures you have the right protection at the best price. 2. Making impulsive or emotional financial decisions. Financial decisions, driven by impulse or emotion, often result in regret and financial setbacks. Whether it's splurging on expensive gadgets, a lavish vacation, or risky investments, without proper research, these choices can drain your resources quickly. Impulse buying frequently happens when stressed, bored, or seeking instant gratification. Large purchases or financial commitments made in emotional states can be particularly damaging. 1. Not educating yourself about money. The single most important mistake to avoid is neglecting financial education. Schools rarely teach practical money management skills, leaving many ill-equipped to navigate complex financial decisions. Understanding concepts like budgeting, investing, taxes, credit scores, and debt management empowers you to make informed choices that build wealth and avoid pitfalls. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.